Something I've talked to subscribers about for probably 2 or 3 months now. The theme for 2023 is boiling frog, and if those of you that don't recognize the phrase, it's basically it's an allegory for the idea of someone in a worsening situation that simply doesn't recognize they're in a worsening situation until it's too late. The old wives' tale being that if you put a frog in a pot and raise the temperature very slowly, it won't notice until it's too late. Those in the Humane Society will be happy to know that frogs are not, in fact, that stupid. If you tried this in reality, the frog would say, "I'm the hell out of here right now." They won't actually sit in a pot, but that's the old wives' tale, and that's why it's used as an allegory for, persons or people waiting too long in a worsening situation and then suddenly realizing, oh shit. That's kind of what I think this year might be like, but this could stretch out even into next year. I mean, right now, I'll start off with my usual disclaimer. Lawyer always wants me to put that in, but right now we're in this very strange situation where for, I would say 3-4 months now, macro is being very contradictory. In macro, you sort of have two types of readings. You've got hard macro, that's things like retail sales, non-farm payrolls, things like that, where they're just the numbers. A lot of it is also things that are actually what's called survey or soft data. So that'd be like ISM services, consumer sentiment, all of those things that are basically based on survey data rather than some objective measurement. And lately, there's been this big divergence, and it really is big. It's the biggest divergence in history, really, between hard data and soft. Hard data is saying, everything's kind of okay. It's fine. I mean, the economy is growing 2 or 3%, nothing crazy, but it's all good. Whereas the survey data, although it's starting to turn now, is generally being quite negative, and that's why you've got these two opposing camps in the markets lately. Basically one camp that thinks things are probably going to basically be okay. We're in a bull market. You've got another camp expecting a recession tomorrow or next week or next month. That sort of keeps getting pushed back. But I think, I think in my own mind, I didn't believe that we had a recession last year in the U.S., notwithstanding numbers that technically said that. Like there was just no way. I don't see one right now. I don't see how you have a recession with 3.5% unemployment. Like that just makes no sense to me. I mean, what drives the U.S. economy is consumer spending, and what drives consumer spending is income. Everybody's working. The odds of a recession starting short term seem very low to me. The only caveat I'd add to that is employment is the last thing that rolls over. So when employment does roll over, the recession's probably coming very, very fast. But right now, you've seen this move, especially in the last month, and this is another good indication of what's been going on here. This is a divergence again. This is somewhat unusual because normally it's Wall Street that's optimistic, and if you look at this chart, I mean, basically the lower number you see there, that's consensus estimate for Wall Street. The upper number is the Atlanta Fed GDP now. Atlanta puts out this reading, and they change it whenever new data comes out, where they do a reading of the growth rate for the current quarter, and it's not perfect, but it's pretty good. They have a pretty good track record, and you can see there's a big divergence between what Wall Street thinks and what the actual readings are telling you. Even now, Wall Street's only calling for 0.5% growth this quarter, which doesn't seem to jive with a lot of the hard data, but that's why you have this. That's part of what led to this Fed pause, Fed pivot. Everybody back in the pool. It's going to be fine. Rates aren't going to go much higher. And okay, that's nice. That didn't show up. One of my charts disappeared. If you saw a chart on the right side of this, what that chart would be is a 2-year yield chart, which has gone up 90 basis points since the beginning of February. That's a very big move. And that's largely because of much stronger than expected non-farm payrolls, stronger than expected CPI, and probably especially stronger than expected PCE. Core PCE is just personal consumption expenditures. This is the inflation measure that the Fed watches. They don't pay that much attention to CPI. PCE is sort of their number. It was supposed to go up 0.4 this month. It went up 0.6. And it's not, I don't really think it's a fluke because this is the third month in a row where it's coming higher than it was supposed to, and it's gone up a larger amount each month. it does feel like maybe, maybe inflation is not only bottoming, but it could actually turn a little bit higher here. We keep seeing service costs in particular, and it's the bigger part of the economy. They just keep going up. They have not leveled out yet, and that's something the Fed watches really closely. Okay, it's on this slide. So this is basically your 2-year yield. That's a very big move. 90 basis points in a month is a huge move. Essentially that's the bond market and not the equity market, because Wall Street doesn't seem to be buying in on it yet, really. That's the bond market saying, yeah, we think the Fed's going to do at least 3 more 25 basis point increases, which I happen to agree with. That's what I think is going to happen too. So basically on the bond market side, at least, the whole one and done, pivot soon, win moon, that's kind of all gone out the window in the last 2 or 3 weeks. Unless we see a real softening in the data, I definitely don't see the Fed pivoting, and I'm not sure I would buy into the idea of them even pausing. My base case right now is the Fed's going to add 25 basis points a meeting. Next meeting, the meeting after, the meeting after, the meeting after. Unless this really starts to roll over, I don't see a pause coming, and I definitely don't see a pivot. There's no way they pivot this year with these kind of numbers coming in. But it doesn't seem to be bugging the market that much. If you look at the S&P, are equity traders freaking out? Nah, not really. I mean, yeah, it doesn't look awesome, but you can argue that it's been an uptrend since October. It's not that far off the recent high. It did really well. Part of the reason the market did really well today was ISM services came out, and everybody was afraid there was going to be a big beat on that number, which there wasn't really. It came in about average. The employment part of it wasn't that high, and probably most importantly, the prices paid wasn't that high. And that's part of the reason why you saw Wall Street rally so much today. But, they're definitely not freaking out. And this is where my boiling frog analogy comes in. I just think until we get to rates too high, and I don't know what level that is, my guess is somewhere between 5.5 and 6, maybe even, and it might even be 6. I mean, I don't expect the market's going to really freak out until we see another 4 or 5 25 point increases. The one thing to understand, though, is this is one of those animal spirits thing where when the markets decide it's one too many, you're not going to get a lot of advance notice. Like, it'll just roll over. Like it'll just happen at some point. But I just don't see that until late this year. I mean, I hope I'm right, but right now the market isn't really that bothered by the fact that the whole yield curve has shifted up by almost a full percent. The equity guys are still like, whatever. They don't seem to be that worried about it. Of course, one place that hasn't been in its happy place because of this move is the gold market. And this is gold on the left, US dollar on the right. Not surprisingly, they're basically inverse charts. You can see basically this is pretty much where that really strong non-farm payroll number came out. That really goosed the dollar, and you get some hard selling in gold, and it just came down to here. I was fairly happy to see it bounce off 1800. It actually seems to be getting some support, which is good to see, because it's not like the US dollar's dropped off again. It's pretty much holding steady and rising slightly, but the gold has managed to actually trade with the dollar. It's also not because of yields. They haven't come off. I mean, the 2-year saw its multi-year high like 2 days ago. So I'm taking some encouragement from the fact that we're actually seeing support in the gold market, even though on the face of it, I wouldn't say the backdrop is bullish. But usually when prices react positively to bad news, that's a bullish sign. That means people think there's been enough selling. So I've still got some hope that gold's going to have a good year. My expectation is still that we probably see a new high later this year, probably late this year, and that's going to be based on the frog getting too hot, and suddenly the market starts to really react to the interest rates. Things start to roll over. The Fed speakers suddenly go, uh-oh, and start getting dovish. At that point, I think you really see gold prices take off, because the US dollar would be reacting negatively to that. The other thing too with again, too much verbiage, but right now we should see, I don't think we'll see too scary numbers when it comes to inflation readings for the next couple of months. We're getting to the point where base effects, and that's simply comparing this year's rate of change to last year's rate of change, because there were some really big up months early in 2022, you get some favorable comparisons. So even though prices are still creeping higher, the percentage change year over year is probably won't look that bad because of base effects. I don't think that's going to fool anybody at the Federal Reserve, but it'll probably make traders happy. And I think right now, I've said really since probably Q3, I just don't see inflation coming down as fast as the market does. The market's starting to change its mind and starting to think like, yeah, maybe maybe we don't get this immaculate disinflation and it just goes back to 2% with nothing bad happening. I don't see personally how it gets back to 2% without something breaking, without a recession. I think it's worth noting that some of the more important numbers on the good side, and this is sort of esoteric stuff like used car prices, those things were big negative impacts on inflation. A big part of the decline was coming from those sorts of numbers in the second half of last year. A lot of those numbers have bottomed. If you look at like used car prices, for example, that bottomed 3 or 4 weeks ago and it's been moving higher again. Medical costs in the US were just weird last year because they did a couple of big technical adjustments. Those are behind us now. Some of those things that really helped on the good side, I think those days are over. The one thing that may save us when it comes to higher inflation is that oil's really not trading that well, and oil has a big impact. And gasoline prices obviously flow directly from oil, and U.S. consumers, the price that they notice more than anything else is the gas price. So if gasoline prices stay down, that might help because it may help consumers not start projecting higher inflation, because what you really don't want is for it to get embedded. So if gas prices stay down, that might help. But my gut feel here is I don't think inflation goes a hell of a lot lower, and it may go higher. And this isn't just in the States. Eurozone, they just put out the highest core CPI in, I don't know, 20 years or something a couple of days ago. Service CPI is not going down. It's still increasing. And you're also seeing increases in Japan. And both of these things matter to us as metals investors and gold investors, because part of what I think may keep the US dollar from being as strong as you might expect it to be, with yields doing what they are, is the fact you're also seeing yields go up in Europe. And there's a lot broader belief now that the ECB is going to be hawkish, which is not a word you normally connect with the ECB. They're not famous for hawkishness, but this service inflation thing, you can tell when you look at the transcripts of the meetings, it's really freaking them out. So I think you may see them adding another percent, which nobody really expected. So the rate differential shrinks a bit between Europe and the US, and that helps cap the US dollar a little bit. And the other place is Japan, where they keep insisting they're going to stick with their 5% cap. Japan has yield curve control, and basically what that means is when yields get to their upper bound, which right now is 0.5% on the 10-year, the Bank of Japan just buys the living shit out of everything in the market. They just buy everything. They take every offer, and that's how they hold the yield down. Japan is sort of self-financing, notwithstanding the fact they've got an insane deficit level. It's mainly owed to themselves. The Bank of Japan is not a bank I'd really want to bet against if I was a bond trader, but you can see the bond vigilantes are definitely starting to now. If that yield curve control breaks, then you see yields in Japan go to 1%, 1.5%, 2%, which doesn't sound like much given what we're living through. But by Japanese standards, that's like a massive increase. If that happens, the yen really takes off, and again, that caps the dollar. It's not a bad idea to keep half an eye on the Japanese yen, because gold and the Japanese yen tend to trade together a lot. There's actually a pretty strong correlation between Japanese yen and gold prices. That's something I keep half an eye on. Basically, as far as the base metal side goes, it looked for a while like the Japanese or the Chinese reopening wasn't going to do anything, but just the last reading, like this week actually, New readings this week looked a lot better. Most of the stimulus that Beijing is doing is essentially, they essentially broadened the lending caps for the banks and stuff. So the $500 billion number that they're throwing around is basically increased lending by commercial banks for new projects and stuff. It looks like that's maybe starting to kick in now because they put up much better numbers just in the last few days. That's going to help base metals. That's really probably the main reason you saw a bounce in copper prices in the last week or so, where it went from like 390 to 415. It's back to about 405, but that was China essentially. So it looks like that's starting to kick in. I'm not, medium long term, I'm very bullish on metals. I'm very, very bullish on base metals. There's just not enough supply coming for the demand that's being mapped out when you look at, green new metals, electric cars, yada, yada, pick your poison. People outside of the mining business, like I talk to people, I get interviewed by people in sort of general media rather than mining media, and they just don't get it. Like they just don't understand. They're going, well, yeah, but we're only talking about copper demand going up like 5 or 6% a year. I'm like, we can't do 5 or 6% a year, guys. Like we cannot do 5 or 6% a year. It is not possible. You cannot get a mine discovered, permitted, that's the big one, and built fast enough to generate 5 or 6%. That's just, if that's a demand increase, hello, $10 copper. That's what we're going to see before the decade's over. And you can say the same thing about zinc, lead, whatever. The added thing, and it's reared its head again. It always seems to, South America, there's all kinds of disruptions. Basically, miners tend to get caught in the middle of these socioeconomic disruptions, but we're seeing them again. It seems like every week there's 2 or 3 big copper mines in Peru and Chile and Argentina that are shut down for a week or 2 weeks or a month because of local demonstrations and stuff, and that just never ends. That's another thing that hurts supply. The third factor, and I tried to get some information this morning on this, but I couldn't find anything useful. One thing that helped, I guess, if that's the word, base metal prices last year, part of the reason why you saw inventories fall off so much last year was there were several smelters in Europe that shut down because energy prices just got so high it made no sense. There was no margin anymore. So, and these are big. Europe has some big smelters, some big base metal smelters. Several of those either had extended holidays. A couple of them just shut down for extended periods. Energy prices are coming down again in Europe. They had a mild winter. Natural gas didn't go to the insane prices everybody expected. In fact, they came back. So, but I haven't seen announcements on reopenings from those, but that's another factor because, zinc mines don't produce zinc, they produce concentrate. Most copper mines don't produce copper, they produce concentrate. You don't actually get the metal without it going through a smelter. So those smelter shutdowns actually help too. And you just add all these things together. And I think, long term, I'm bullish enough on base metals that I'm not really sweating the short term stuff that much. Yes, I think there will probably be a recession. I don't think it happens till late this year. Maybe it's a mild one. The problem with recessions is you never know in advance, and it's one thing to keep in mind too is that when you look at Wall Street and when you look at what they talk about, Wall Street always prices in a soft landing. Always, it's never a soft landing. That's always what they price in. So keep in mind that when things roll over, the profit decline in even a mild recession is 20-25% on average. That's not priced in. Like Wall Street has not priced in a recession. Whatever you might hear from talking heads on CNBC, it hasn't priced in a recession at all, actually. So keep that in mind. When things do roll over, Wall Street will get whacked. But it just doesn't feel to me like that's coming that quickly. I mean, until I see rollover and things like payrolls, it just doesn't feel to me like this recession's that imminent. So I'm not going to lose a lot of sleep worrying about it. And like I said, base metals, most metals really, I'm so bullish over the medium to long term that, if there's a slowdown and stock X that I own drops 20%, like whatever, I'm not going to be losing sleep over stuff like that. I'm more concerned about being positioned in good development stories and good exploration stories that have real upside potential.